And we're back. You are listening to the Exitology Unlock Your Profits, Unlock Your Potential show on International Business Growth Radio. I'm Jason Wally Waldron, your host. And today I am joined by Jordan Burg and David Blauzen of CG. Help me out, Jordan. Help me out.
Yes, CSG Partners.
Start it. I'm sorry. CSG Partners. And I got hung up because we're talking ESOPs. And so we've got all these different.
Too many acronyms.
Too many acronyms. But I'm loving it because what we're talking about here today is what does a good fit look like for an ESOP? And so longtime listeners of the show, of course, know, we're going in and talking to manufacturers all day long, and we're talking to industrial companies and really the blue collar companies of the world. And there's a few commonalities that we have when we're working with these companies. One is that oftentimes they are multi-generational and family owned. Number two is very often the ownership is getting up there in age. As we talked about a few minutes ago, they are part of that silver tsunami. And also a lot of times the second or third generation that would normally be the ones that you would have asked to step into this company and run it, they're nowhere to be seen for all of these different reasons. And so you have a very big opportunity, but also a challenge in front of yourself. And so I'm going to even throw one more data point of what we see here in the manufacturing space, especially here in Colorado, but really everywhere where we're nationwide. So we see it everywhere. And that is, you have these companies that have been built by an engineer type person and somebody who built the client base a long time ago. And it looks like a company, it breathes like a company. They've got employees like a company. They've got all the facilities and everything. And when you really peel back the onion, they've got 4 giant clients. They've got massive client concentration risk. And it's freaking me out because they're going to go out of business in the next few years. So with all of that in front of you, I'd love if we could talk through some situations where you've gone into industry, you've gone into manufacturing, you've presented the ESOP concept, and maybe walk us through a few examples of how are we able to use the Swiss Army knife of the ESOP to solve some of these challenges and opportunities.
An ESOP can be a great fit for dozens of industries. Generally speaking, regardless of what industry we're dealing with, it comes with significant tax benefits. Now, when you dive into certain industries, let's talk about asset heavy, maybe it's a construction company, a material handling company, or a transportation company. Mm-hmm. You have an asset heavy business. And an ESOP can provide different tax benefits depending on what industry we're talking about. So for a material handling business, right, you've spent a lot of CapEx, you have a lot of assets on your business that maybe you've depreciated down over time. Now, if you were to sell your company to any third party, 9 times out of 10, you're probably talking about an asset sale. When you and you would recognize depreciation recapture on those assets when you go through that sale. When you sell to an ESOP, it's an equity sale. So right off the bat, depreciation recapture is not something that you have to worry about. One of the benefits we talked about on a prior episode is that the owners can also receive a significant tax break, which is that they can defer and ultimately eliminate the capital gains tax that's due on their sale via what's called 1042 of the tax code. It's very similar to a 1031 if you're in the real estate industry, but 1042 was created specifically for ESOP transactions.
And so, David, before we go further, and I apologize, I'm going to take this down to as if I were a 5th grader for a second. What you're saying is selling into an ESOP, when you say depreciation recapture, right? Let's say I've got 30 years of the depreciation curve that I've benefited from. That's taxes I didn't have to pay. And in scenario A, no ESOP, I'm going to have to pay all those back taxes, essentially, is what you're saying. Scenario B, not so much. And right, am I boiling that down to the essence?
Exactly correct.
Beautiful. So all right, keep walking us through there. I just want to get the gist of that, because again, You're over,
Absolutely. So simplistically speaking, you have a company that's worth $100 million. Depending on what state you're in, capital gains tax is different. But let's say you sell your company for $100 million. Maybe your take home on an after-tax basis is $70 million or $65 million, depending on how much you were taxed on the sale. When you sell to an ESOP, you have the ability to actually take home $100 million after tax, and that is significant.
And I can't emphasize enough that you've also benefited from that tax strategy beforehand, right? So really, you're getting the benefit of your life's work both times, and so I think that's really important. So we talked about just a second ago, so that's a company with significant hard assets or high depreciation. What about high relative payrolls? Right. I mean, if I'm running a manufacturing firm and I've been doing it in America, I've got some really smart engineers who cost me a lot of money on the payroll, but they're worth every penny. So how does it work in that scenario?
Payroll is one of the significant aspects of a company that actually drives your ability to use those tax deductions within an ESOP-owned company. The higher your payroll, the larger the tax deduction that you can actually take within an ESOP-owned company. Now, you can take up to 25% of your payroll as a tax deduction at the corporate level. Okay, so and that tax deduction flows through your statements just like depreciation does. You're not actually spending money, but you're receiving that tax break.
Okay, that's pretty cool. So so we got a place to put all of those resources. What about it? Is a management buyout the same thing as an ESOP, or are they related?
Similar concepts, but they are different. Now, when you think about it, a management buyout, right, that the management team is buying the equity of the company. When you sell to an ESOP, all employees are participating in the ESOP transaction. All employees are going to receive some share of the company over an extended period of time. It's a free benefit to all of the employees. It's not like a 401k where any employee has to say, I want to allocate maybe 5 to 10% of my W-2 compensation to the ESOP, like you would to a 401k. Instead, participating in an ESOP is a free benefit above and beyond your typical compensation. It has zero impact on your W-2 compensation. It is a free benefit provided to you by the company.
And so as you go through this thought process, I'm attempting to put myself in our business owner's seat. Oftentimes we're working with a business owner 3, 5, maybe even 7 years out from exit. And really, of course, on our side, we're working to help them grow so we can fund all of these types of advanced strategies for the best outcome of everybody involved. And so one of the questions that a business owner would have, I think, around an ESOP would be the participation on the other side. So if an employee stays with me, they're participating in the ESOP. What happens if that employee leaves?
So here's the, sorry, Dave.
Go ahead, Jordan.
Okay, so I mean, that's another good thing about the ESOP. Companies are protected from kind of folks who could theoretically game the system. Why?
Okay.
Because in a leveraged ESOP transaction, the stock that is sold is going to be parceled out over a number of years, 10, 15, 20 years. So it's not employees. And if you're there on day one, you're not getting your complete share of that transaction.
Okay.
You're getting, if we're parceling out over 20 years, you're getting 1/20th of that share, right? That's the first thing. So this is a long tail process. Secondarily, ESOP shares are subject to vesting, usually with 3 to 6 year periods, much like a 401k. So if you leave the company with unvested shares, it's just that the shares get returned to the company, returned to the trust for circulation down the road.
Gotcha.
So when employees leave, they're truly taking with them what they've earned. They're not really taking with them. I mean, technically the trust still holds the stock, the trust sells those shares back to the company at a fair market valuation, the employee gets that economic value. If they're not at retirement age, sometimes those payments are spread out also over a period of a number of years. Now, granted, we call that repayment liability. Companies can plan for that as well, and should plan for that. But I'd say an ESOP is a structure that really keeps everyone honest in that regard.
Yeah. Cool. And you've shared with me, so good fits include an owner looking to ease out, but maybe not just pull that pay patch, so to speak, right? They're going, dipping the toe in the water, taking one step at a time, taking a couple bites of the apple, so to speak. You've also shared with me that family-owned companies are very good for considering ESOPs and these types of solutions, and folks with relatively high payrolls. Are there certain challenges that maybe American-based manufacturers or just industry in general, all up and down the supply chain, are there challenges that an ESOP can solve that maybe some of these other exit strategies cannot?
I mean, it's just it comes down to if we value the independence of this company, right? What makes this company stronger in the long run? So what still earns the liquidity opportunity for the owner? What helps the company maintain independence? And then what makes it competitive vis-a-vis domestic and foreign players moving forward? And I would say that as far as what we hear with manufacturers all the time is the war for talent is brutal, right?
Okay. Yep.
So both finding new talent, but also retaining the employees that you have. And an ESOP is a real game changer in that regard. Because
that's awesome because it can it can give the ownership bench a way to move on to the next stages of their life, but still maintain their legacy, still maintain their culture, and attract and retain that talent that they need to make it all work.
Correct. It's for some employees, it's almost like a golden handcuffs, and I mean that in the best way possible. Yeah. But you're giving up on a lot of potential value by leaving the company.
Well, that's really great. So here, so we're gonna take a short break here for 2 minutes, and then in the next section, we'll talk about some Colorado specific ESOP things that are happening that are really exciting. You're listening to the Exitology Unlock Your Profits, Unlock Your Potential show on International Business Growth Radio.